In today's video, we're going to discuss if we should be focusing on building up cash savings at higher interest rates instead of investing, and the best places to do that currently. Since the financial crisis, the decision between saving cash or investing has been easy.
The headlines mark yet another historic low.
14 years of record low rates meant savers were left to endure pitiful returns on their cash.
Like Jim and Dorothy Ogden, the couple will be earning less interest on the money they have in the bank.
Someone please tell Jim and Dorothy it's going to be okay, because in the space of 18 short months, everything has changed.
Jim's dead!
In the 94 years between 1928 and 2022, cash has beaten stocks around 29 times. 2018, 1994, 1981, when Paul Volcker, tasked with confronting inflation head-on, cranked interest rates
15%, 18, 19, 20%, 21%.
But the most recent is 2022. Stocks dropped 18%, bonds down around 13%, and cash produced a nominal return of 2%. With 2022 being one of the worst years for investors in decades, is it any wonder that the bitter sting of this decline still sits fresh in the memories of investors this year?
Oh God.
There is a saying that goes, generals are always preparing to fight the last war. It means we have this tendency to plan for past events when actually we need to adapt to what is coming. Looking at 2022 as an example and sitting in cash this year will have seen you miss out on the bull run that has been 2023 so far.
Up 17% this year.
So how do we decide if we should hold cash? Before we do that, let me tell you about today's video sponsor, Huel. I honestly love Huel, and it's not just because it's nutritionally balanced, vegan, full of protein and vitamins and minerals. My favourite flavours are the vanilla and chocolate black edition. There's this whole other reason I do. So I don't know if I mentioned this, but I recently got attacked. Did I mention that? Don't think I did. Kept it on the down low. We can laugh about it now. So one of the side effects of a massive face, broken teeth and all of that was I couldn't chew anything. I had to tell Huel as well that I wouldn't be able to do our planned sponsored slots for a while because this is hardly a face for TV, is it? But this is how they replied. I hope you recover quickly and thanks for letting me know. Take all the time you need. And also, I just want to add, if you need me to send you any Huel to help along with your recovery, then please let me know. We have lots of customers who go through injuries, illnesses or surgeries and have got in touch to explain that Huel really helped them during that recovery. For at least 3 days, I sipped exclusively on Huel while my face came down from being so swollen. And it was an absolute godsend. Huel isn't just a great product that fits in with my lifestyle and stops me eating crap when I'm hungry in a rush, but they're also a great bunch of people who really care about their customers and the people they work with, clearly. And this is why I'm happy to work with them. I can't thank them enough for this lovely gesture that they did for me, when I needed it. If you want to try it out for yourself, then there's a link in the description box, or I'll pin one in the top comment for you as well. On screen is a chart produced by Schroders that displays cash's chance of beating an investment in stocks over different time periods. 1 year is the 31% that we discussed before, but notice how the longer the time frame, the less chance cash has of beating the returns on stocks. Pick any 25-year period in the last 100 years, and stocks have always outperformed. Now you might go, well, okay Damien, but that's because that's the S&P 500 and it's done really well. So let's pick a country that isn't exactly smashing it at the minute then. Each year, Barclays produce a report called the Equity Gilt Study, where they track the performance of UK stocks, bonds and cash savings and compare them with each other. They found there was a 91% probability of UK equities, the flat-footed FTSE, outperforming cash over any 10-year period in the last 123 years. This outperformance long-term can lead to a huge opportunity cost if you sit in cash for extended periods of time. So the 8% outperformance from stocks in any given year is significant. But over 25 years, the outperformance difference means that stocks on average produce a return that's 1,281% better than that of a similar cash holding. This is what that difference looks like. The red line is a global index, the grey line is inflation, and the pink line is cash. For long-term saving goals above 10 years, really the stock market is the place to be. To understand why this is the case, why are stocks such a better long-term bet? Take a look at this produced by the New York University and look at the distribution of returns over the same period for stocks, bonds and cash. Basically how much they swing as a percentage from top to bottom over the time period. So the blue number is the average return over all that time, and the green is the biggest gain in a single year. As you can see, there's a huge range between the top and bottom here, but notice how tight the spread is with cash. And the fact that the lowest number here is 0. We'll come back to that in a second. Stocks can go up a lot because they can also go down a lot. It's just simple risk and reward. In a normal functioning economy, long-term stocks will produce the best returns, but be the most volatile. Then they'll be followed by bonds and then cash. In a year when cash outperforms stocks and bonds like we got in 2022, the headlines can be scary and the system can seem a little bit broken.
Cash is king right now.
Why on earth would I invest when I can just get a safe, steady 5% right here? But it's just a reminder that in any given year, anything can happen. And this is the risk people talk about, but it's also why we invest long-term and not just in 12-month periods. Cash's poor long-term performance versus stocks is actually not a negative. It's a feature. It's part of the main trade-off that you need to accept for the main benefits of cash. Cash has never produced a nominal decline. That's the zero right here. Slap $1,000 in a bank at 0% interest rate in 1928 and you will still have £1,000 today. That sort of certainty and security is actually quite valuable, especially over shorter time periods. We can't rely on stocks in the short term, as we've seen by the performance. It's just all over the place. But we can rely on cash to some degree in the short term. We can be confident that if you, say, have a house deposit, holding it in cash makes sense, as the nominal value won't fluctuate. You can slap your 20k in the bank and you'll still have 20k in 12 months. There's no such promise with stocks. But of course, there is an issue here. I said nominal returns. The one thing we haven't mentioned is
Inflation
affects the value of all assets. It isn't just a force that eats away at the spending power or the value of your cash. It eats away at the returns of stocks as well. If a bank is paying you 5% interest and inflation is 10%, well, you're down 5% in real terms. And the exact same applies to the stock market. So what we need to work out is which asset has the best chance of outrunning inflation long term. Another graph from Schroders for you. This one instead, though, shows the chances of cash and large company stocks beating out inflation over certain time periods. So in any given month in the last 100 years, holding cash and holding stocks, you have about a 60% chance of beating inflation. This 60% chance then holds pretty consistently for cash over 1, 3, 5, 10, and even 20 years. Not very good odds. But notice how stocks increase. If we now start in recent times and go back 5, 10, 20, and 50 years, stocks, both large and small cap or big and small companies, are the only type of investment that has consistently outrun inflation over the below time periods. Yes, cash savings and the interest payments you get are more attractive than they have been in the past. And it feels pretty good getting a 5% return or whatever on your cash. But that doesn't change how I view cash in my investment mix. Just because the rate has gone up on cash and came out on top in 2022 doesn't mean that I'm now changing how I do things. I'm not preparing to fight last year's war. Because by that logic, we should all be deep into rock and monkey JPEGs still, because that was the highest performing asset class of 2020. In any given year, what will happen, what will perform the best, is essentially a dice roll. So I don't try and guess. Instead, I say any savings goal above 5 to 10 years, retirement, kids, whatever, that is going into the stock market because stocks have a proven track record over the last 100 years for providing better returns and outpacing inflation. Anything under that time period, and I'll be sticking it into whatever the highest paying cash saving equivalent is that I can get my hands on. If rates on cash savings at the time are good, well, that's brilliant. If they're not, well, then that sucks. But the fact that I need the money short term is the determining factor, not the on-offer nominal rate of return. Time is the key decider on if it's cash or stocks or not. Okay, so let's say you've got some cash and you're looking to maximize the return on your emergency fund or whatever. Let's look at some of the best places right now to stick cash at the moment. My preferred way currently of saving is through a money market fund. The rates you achieve are significantly better than high street savings accounts, and you have full flexibility with your money. You don't have to do all of this, lock it away for a year to get the best rates or whatever they're doing at the minute. I will try and explain this as best as I can, and I will oversimplify it for the beginner. Then I'll link a video in the end cards and in the description from Roman at PensionCraft who goes into more detail on this topic. I'm showing you the one I buy on both Trading 212 and InvestEngine. Both are linked in the description for you. So the fund I buy, which is just one option, states that the fund seeks to track the performance of an index comprised of sterling-denominated investment-grade corporate and quasi-government bonds. And all that means is they're IOUs to companies and governments that don't have a long time left until they're paid back. You buy into the fund and over the course of 6 months, the price of a unit in the fund goes up, as we can see here. It starts at £100 and then climbs. And then this steep decline here is when the fund pays out the income that's been collected over this time period, taking the price per unit back to the £100 level in this case. You can also get accumulation versions of these types of funds as well on different platforms. Now you can sell out of the fund at any point along this line. You don't have any restrictions. You can take your money out at any time, locking in that gain. As the Bank of England base rate goes up or down, so will this return. That means if you have concerns around banks not passing on higher interest rates to savers, money market funds solve this problem. There are more risks here than you get, say, with a high street savings account, but we're not talking stock market risk. The chances of a decline like you might get in a global index are very low, but they do exist. Watch Romin's video if you're interested in this type of fund. Like I said, I'll link it in the end cards in the description, and he has a whole section of risks, and really this topic is a standalone video in its own right, and he does it far better than I could. I personally don't think that risk is significant enough for me to not get the superior return. But if you're not comfortable with that, then you can go with a traditional savings account. The rates on these move constantly, so I've linked below Andy Clevercash and Martin Lewis's pages that have daily updated live reporting on the best current rates for all different types of savings accounts, premium bonds, all of that stuff. So whenever you're watching this, the video still applies. Please make sure you consider tax implications of any cash savings that are not inside of an ISA. That includes both savings accounts and money market funds like I just showed you. You get up to £1,000 a year in tax-free interest on cash savings before it's taxed by the government, and this declines depending on which tax band you're in. When saving rates were really low, this wasn't an issue. But let's say that you're a higher rate taxpayer now. You only need more than 10k in cash savings at 5% to hit the £500 a year limit. Anything above that, there's tax that applies. You can use a cash ISA to avoid this, but you'll be using up your ISA allowance, which is 20k across all ISA types for the year. This changing of rates and the tax situation is likely why we've seen record amounts of money flood into cash ISAs as people try and avoid this tax. There are only a handful of times throughout history where you could build wealth by having cash in a bank, and right now isn't one of them. More often than not, in real terms, your cash is going backwards because inflation is higher than the interest rate that you're being paid, and that applies right now. Remember, cash is far from a risk-free asset. It's just that the risks are not as clear to the naked eye. Here's Romin's video on money market funds. I love him, and I'm actually going to sit down with him on this Thursday, which is the 24th of August, to have a live chat on his channel. So yeah, come along for that as well, and I'll see you soon.